here is that price is also stacking up sell side liquidities here. And since we're in a bearish market condition, we want to see the market takes out the buy side liquidity before we have the bearish continuation of price to the downside. Here we have a valid pullback because this took out this candle high. This is the last bearish candle, and then we have this bullish that took out the high. So it's a valid pullback. So for us to have further bearish continuation, I want to see how price takes out this high. This becomes our inducement. We want to see price takes out the buy side liquidity before we have continuation to the downside. So let's play price to see. Okay. But this, what we can see is that the market just fell to the downside, took our sell side liquidity, and then we have the break of the swing low. We still have our buy side liquidity resting here. So we could see that possibility of price taking out the buy side liquidity. Hello guys, welcome to the next Well Trading Hub YouTube channel. In this video, we're going to be looking at the concept of inducement, which is a crucial part in effectively reading price action in the markets and identifying ideal institutional structures. Some of you reach out to me expressing your concern regarding how to identify inducements in the markets. Our tells basically tell us that inducements is a manipulative movement sponsored by the institutions to trick retail traders into taking position against the ideal institutional direction. Inducement is a liquidity concept that refers to the targeting of short-term highs or lows as areas to place stops. This is what you must always take into cognizance when you're looking out for inducements. It's a smart money trading concept that helps traders avoid losses and catch more wins. In simple terms, we can say that inducement refers to the process by which market movements encourages traders to take positions that are designed to fail. Inducement in trading refers to a situation where large market participants, like the institutional investors or smart money, manipulate the market to create a false perception of the market's direction. The goal is to induce retail traders or less informed participants to take positions that are contrary to the true intentions of these large participants. So guys, let's look at a bearish case study on how to identify inducements. Here, what we can see, we're having the movement of price to the downside. Here we have the impulsive leg move to the downside. We have this pullback. So I'm going to show us this inducement identification in two cases where we have that the market gives us a pullback, but then failed to continue to the downside to take out this swing low. This is the first scenario we're going to be looking at, because a lot of people have this conception that this is just the ideal inducement where the market would give a pullback and then an impulsive move to take this swing low point, and then we have a movement to the upside to take the swing high point before we have the further push of price to the downside. You must understand that you mustn't approach the market with a textbook perspective. Textbooks examples are meant to guide you, to give you an understanding of structural delivery, of the price delivery in the markets, but then you must be able to understand the concepts and then interpret the concepts based on price movements in the live chart. So what we can see is we have the impulsive bearish move to the downside. Here we have the pullback. Price gave us this movement. Price created this swing high points. And now we have this push that failed to take out this swing low point. And we already know that we are in a bearish market condition. This swing high point becomes our inducement. This becomes the point where retail traders will be expecting to place their stops, so that when the market pullbacks, they would see this as a resistance level for price continuation to the downside. And here we can see this movement failed to take out this swing low points. So this shows us that the market is aiming to take out the buy side liquidity, which is the inducement, mitigate any form of sponsorship zone here. It could be a fair value gap, it could be an order block. And here we can see how the market pushed to the upside, took out the inducement, the buy side liquidity. The institutions definitely would keep aiming for retail stops because they believe that they created the swing high points. Retail traders would expect to put their stops above this swing high points, expecting further push of price to the downside. So since the institution know that the retail traders will be looking forward to plan their orders at this inducement zone, they would raid out the stop loss before we have the price movements to the downside. And what you must understand is you want to see this inducement formed where price doesn't return to the premium price zone or the equilibrium price zone. So this is trying to show us that the market has a probability or tendency to aim higher into the equilibrium and above the equilibrium, which is now the premium for a bearish market condition before we have the bearish continuation. So the inducements is a manipulative price movement. So retail traders will be expecting to have further bearish move. So they place stop losses here. The institutions will now manipulate the movement to the upside. So this is the manipulative movement to the upside, where now the institutions will take out all stops resting above the swing high points before further pushing price to the downside, because the institutions will be aiming to mitigate a sponsorship zone above this swing high points. So the inducements could be formed below the premium price zone and below the equilibrium price zone. Therefore, the institutions will aim to take price to premium in a bearish market condition before they continue the bearish movements. So in this case here, what we can see is we have the impulsive move to the downside, price pullback. Price fell to the downside, took out this low points. But now what we can see is this is now the inducement price movements to induce retail traders to take their sell position and put their stop loss above the swing high points, because retail traders will be expecting this to act as a resistance. Price should come, retest, and then we have the continuation to the downside. But then the institutions would know that retail traders are expecting for the bearish move and the stop loss are right above the swing high points. So the institutions will take out those stops to mitigate sponsorship zone within this expansive leg move. It could be order block, it could be a breakout, it could be a mitigation block, it could be a fair value gap to continue the bearish movements. So the movement to the upside that takes out the swing high points becomes a manipulative movement. So this is the manipulative structure that was created. And now this is now the movement to take out the stops above the swing high points. So this swing high point is going to induce retail traders to take short position at this retest, because the retail traders will consider this as a resistance and the stop loss will be above the inducement, the swing high points. So we can also consider using the flip tool to check the level of the inducement leg. When you plot the Fibonacci from the high to the low, there is a possibility that the pullback is not up to 50% or within equilibrium price level. Therefore, we should expect the possibility of price returning to the upside above the equilibrium into the premium price zone in confluence to sponsorship zones in the expansive leg move before we further have the bearish movement to the downside. So the inducement swing point helps us identify the accumulation, the manipulation, and then we have the distribution to the downside. So we can see impulsive move to the downside, price pullback, price gave us this movement to the downside, failed to take out this swing low point, which is the sell side liquidity. And then we see the market pushing to the upside. So we should know that the market is trying to take out the buy side liquidity, which is now our inducement. So this can now be considered as the accumulation zone. Now price will give us the manipulation. This is the manipulation movement. Why? Because this takes out the stops resting above the swing high points. So price gives us the manipulative movement of price to the upside, giving us a force breakout where the retail traders may now be considering taking buy position, and then we now have the ideal distribution to the downside in confluence to the ideal institutional direction. So this is now our inducement in a bearish market condition. The movement that the institution creates to manipulate retail traders into taking positions. So we have this movement to the upside. We have the 4. So this will be considered as a resistance. Retail traders will place positions expecting a retest and then a continuation to the downside. But then the institution will take out all the stops resting above the swing high points. And then we have the distribution to the downside. The same applies to the second scenario. We have the push of price to the downside. We have the pullback. Price created this swing high points. And then we have the 4 that took out this swing low points. So we know we are in a bearish market condition. So we're looking forward to see how the market will take out buy side liquidity, which is now the inducement, before we have the continuation to the downside. This forms our accumulation zone. Now we have the push of price to the upside, giving us the manipulation, because this took out all stops, giving us a force breakout. And then now we have the distribution to the downside. So this is the concept of inducements in a bearish scenario. you want to see the inducement possibly not within premium zone or the equilibrium zone in a bearish market condition. Therefore, we should expect the possibility of price movements into premium before we have the continuation of bearish movements to the downside. So this is what you should understand about the inducement in a bearish case. So we're going to look at a bullish case study to that. So let's look at a bullish case to that before we head to the real-time charts to look at chart example to identifying inducements in the markets. So what we can see in this bullish market condition, we have the impulsive leg move, we have the pullback, and then we have this movement to the upside. Price failed to take out this high points. So what I'm trying to make us understand is the impulsive move to the upside, when price gives us the pullback, doesn't necessarily have to take the external range liquidity before we consider the swing low points within this impulsive movement as the inducement zone. So most people look at inducement that inducement needs to take out this external liquidity before this can be considered as a valid inducement. So that is why I told us guys not to base everything just on textbooks theoretical examples. We must go back to the chart, backtest and backtest to have apt understanding of this from chart deliveries. So what we can see now is the market failed to take out the external. Yeah. And we're in a bullish market condition. So there exists the possibility that when you feed from this low to this high, the inducement, this swing point that was created is not up to the equilibrium or the discount price zone. And now we see this movement that failed to take out the external liquidity. So we should expect the possibility in the markets that this would return to the downside to take out the swing low points before we have the impulsive movement to the upside. This fails to return to discounts or equilibrium. So we should expect the possibility of the market deepen lower into discounts in a bullish market condition before we have the bullish continuation to the upside. So we can see now this swing low points act as the inducements. So the institutions will give us this manipulative movement. We'll have a false breakout here because we have stops resting below this swing low points. Retail traders are expecting to see a movement, a retest as a support, and then the bullish continuation to the upside. So here is the second scenario where we have the impulsive move, price pullback, and then price created the swing low points, and then we have the push that took out this high points. Now we could see the possibility that this pullback is not within equilibrium or discount price level. Therefore, we should expect the existing possibility that the market would pull back into discounts before we have the bullish continuation to the upside. The price will pull back into sponsorship zone within the impulsive leg move in confluence with a discount price level before we have the impulsive movement of price to the upside in the ideal institutional direction. So this also gives us the accumulation, manipulation, and the distribution model, where we have now price gives us the accumulation phase. We're expecting to see that the market will take out sell side liquidity before we have bullish distribution to the upside. So here we have the impulsive move, price pullback, possibly failed to reach discount or equilibrium. So we should expect that the market should take out the buy side liquidity, reach into the discount price level, mitigate sponsorship zone within the impulsive leg move, and then we have the distribution. So this is the manipulative movement because this takes out all stops resting below the inducement swing low points. The same applies to this other second case study. We have the impulsive move, price gave us a pullback, creating our inducement, our sell side liquidity. And now we have the impulsive movement of price to the upside. Price took out this external liquidity, but then we would see the possibility of the market returning into discount price level in confluence with sponsorship zone within the impulsive leg move to mitigate either an order block, a breaker block, a fair value gap, and then we have the distribution to the upside. This is our manipulation because this takes out all forms of stops resting below the swing low points of the inducement, which is the sell side liquidity. So this is the bullish case study. You want to see price create that force movement to induce retail traders into taking position, and then we would expect to see the possibility of price really pulling back and taking out all stops resting within that swing low point in a bullish market condition before we have the distribution to the upside. So what am I trying to still show us? When we look at this more profound chart delivery or chart example. We have the bearish case, and here we have the bullish case. So what we can see is we have price gave us the impulsive move. Price gave us this pullback to the upside, and then we have the fall of price to the downside. Here we have the inducements. Price created this swing high points. Now, the expectation of retail traders is to want to take a sell position, expecting this to be a resistance, and then we have stops resting above the swing high points. So what the institutions would do, since the market moved to take out external liquidity, return to take out internal liquidity, fill up inefficiencies. So we should expect to see the possibility of the market returning to take out all stops resting above the swing high points before we have a continuation to the downside. So this becomes our manipulative movements to induce retail traders to take sell positions and then stops resting above the swing high points. And then we're going to have a forced breakout, which also will manipulate retail traders to want to take a buy position. And then we'll see the institutions will return price to the downside, which is the ideal institutional direction. Now, in this particular price delivery, what we can see, price took out this one. Price to return to take out the internal, which is now the inducement, and then we have the fall. Now we can see in this other example here, in this other leg delivery, we can see the pullback to the upside. Price failed to take out this. We should still expect to see the possibility of price returning to take this out, because where we should feed from the swing high to the swing low points, there is the possibility that this pullback is not up to equilibrium or the premium price levels. So we should expect the possibility of the market pulling back into premium before we have the continuation to the downside. Price failed to take out the sell side liquidity. We saw price pushing to the upside, so we should know that price is aiming to take out the buy side liquidity before we have the fall to the downside. So now we can see that now price here mitigated a higher time frame PDRA. So we have price created the swing low, price pullback. This is now your inducement. But when you see price mitigating a higher time frame PDRA, this inducement creates the market structure shift when it is broken to the upside, because price is reacting at a higher time frame PDRA. So we can see now price fell to the downside, took out the sell side liquidity. So we have this push of price to the upside, price return. Since price is reacting at a higher time frame PDRA, retail traders will be expecting this should provide a support for price. Therefore, they will take their buy position here and then place the stop loss below the swing low points. So what we would see, the institutions will manipulate the movement to the downside to take out all stops resting below the swing low points, and then we have the push of price to the upside. Now this is the inducement, but since we have price mitigating a higher time frame PDRA, this creates our market structure shifts. Now we have price created a high point. Now we have the push of price. Price give us this movement, did not take out this swing high point. So we should expect to see that market is aiming to take out this liquidity, the inducement, before giving us a further bullish movement to the upside. Now we have the fall of price. Price gave us this movement, took out this high point, and then we saw the market returning to the downside. Since we know we are in a bullish market condition, we should expect this return to take out internal liquidity, which is the inducement. Price should mitigate sponsorship zone within the expansive leg move, which could be a mitigation block, a breakout block, a fair value gap, and order block, and into the discount price levels. And then we have the push of price to the upside. So this is how you want to be looking at inducements. You want to be identifying inducements in the markets. You want to see how price returns to take out an internal liquidity, which is the inducement, before you have the bearish continuation. You want to look at how price would return to take out internal liquidity, which is the inducement in a bullish market condition, takes out the swing low points to the downside before we have the impulsive movement of price to the upside in a bullish case. So you want to see market mitigate a higher time frame PDRA, takes out the previous low that was formed, because retail traders will be expecting this swing low to act as support. Since price is reacting at a higher time frame PDRA, institutions will manipulate the movement to the downside to take out stops before we have the push of price to the upside. For this to be validated as an ideal high point, then it should seek internal liquidity, which is the inducement. For this to be regarded as an ideal low point, then it should seek internal liquidity, which is the inducement. So this is how you want to be looking at the inducements, how to identify the inducement in the market. So guys, let's head to the chart to look at practical real-time chart example in order for you to understand how to identify inducements. So guys, we'll be looking at a real-time chart example, and here we can see we have a bearish market condition. So, when we're in a bearish market condition, we want to see the market takes out the buy side liquidity, which is our inducements, before we have the distribution to the downside. So I trade using the New York time zone. So you must understand that at 12 a.m., that's the midnight hour, New York time zone, when we see the market opens at 12 a.m. using the New York time zone, we're expecting to see how the market will trade above the open price at the midnight hour in the bearish market condition before we can consider going bearish in that market condition. So in a bullish market condition at the midnight hour using the New York time session, we want to see price trade below the open price at midnight hour before we take a bullish market condition. The same applies to when the New York session opens at 8:30. So for you to have a better understanding to this concept, then you need to enroll for the mentorship program. So when you see this is a bearish market condition, so we're expecting to see further bearish movement to the downside. Here we have a new day, another new day, another new day here. So these are the session separators. So let's play price. Since we can see now that the market is giving us this impulsive movement, here we're having a pullback. So you can utilize the FIB tool for you to identify your ideal inducement zone. So let's play price to see the structure that will be formed within the pullback leg move. So we can see price push to the upside. Now here is our premium, here is discounts, this is equilibrium. Now we can see that price is still within the discounts. In a bearish market condition, we want to see the price trade into premium. Then we have the bearish continuation to the downside. So we're going to look forward to see if price is going to dip into premium before we have the bearish continuation of price to the downside. What we can see is that price is giving us an accumulation phase here. Let's play price to see. We can see that price is giving us this accumulation phase here. So we are having stack of this buy side liquidity, and you can also see we have sell side liquidity below here. Here's the sell side liquidity, and we have the buy side liquidity resting above. So, and you can identify that this is within the discounts. It is within the discount PD array. So we are in a bearish condition. We're expecting to see price takes out the buy side liquidity, mitigate premium, and then we have the bearish continuation. So just the way I've also stated about the midnight hour, we can see here that price gave us the 12 o'clock midnight candle. This is the open price. Now price is trading above it, but we want to see price dip into premium, and then we have the fall. So this is accumulation. So I want to see the manipulation and then the distribution. So let's play price to see. Okay, so what we can see is that now price further went to the upside, took out all buy sides liquidity. Price have not mitigated premium, neither equilibrium. So there's a possibility we could see price dip more higher before falling to the downside. But what we can see is that price have already taken all this buy sides liquidity. So if price should drop to the downside and take the sell side liquidity, then we may not see that return into premium. So let's play price to see. Okay, now we can see we have this impulsive movement to the downside. Price fell to the downside. So what you can see in this market condition, price did not dip into equilibrium or the premium, and then we had the displacement. Now we can see we have a valid break of structure. Since we have price took out inducement, price fell, took out external. So we have a valid break of structure. So let's play price to see. So what we can see again here is that price is also stacking up sell side liquidities here. And since we're in a bearish market condition, we want to see the market takes out the buy side liquidity before we have the bearish continuation of price to the downside. Here we have a valid pullback because this took out this candle high. This is the last bearish candle, and then we have this bullish that took out the high. So it's a valid pullback. So for us to have further bearish continuation, we want to see how price takes out this high. This becomes our inducement. We want to see price takes out the buy side liquidity before we have the continuation to the downside. So let's play price to see. Okay, for this, what we can see is that the market just fell to the downside, took our sell side liquidity, and then we have the break of the swing low. We still have our buy side liquidity resting here. So we could see that possibility of price taking out the buy side liquidity. So let's play price to see. Wow. So we can just see the further push of price to the downside. And one thing we should pay attention to is when we flip this, we can see that the market did not dip into equilibrium, neither the premium. And then we have the fall of price to the downside. Now price created this new low point. So let's feed our Fibonacci to the new low point to see. So you can see that now this is the new low point. Price is still within the discount zone. Price did not mitigate equilibrium or the premium. This is not deep more higher before we have the fall to the downside. So this is our inducements. So we'll be looking forward to see how price will take out this inducements, since these did not pull into equilibrium or premium before falling to the downside. So let's take out the fib tool and then play price to see. So now what we can see is that now this price is pulling to the upside. Price did not create any pullback here before continuation. That would have been our new inducements. So now we'll see that the market will seek this inducements before we have a continuation to the downside, because you would also see, or you've seen, that this did not dip into equilibrium or the premium. Since we're in a bearish market condition, we'll be looking at price dipping into premium. So we're expecting to see that now price will take out this. Price have created the swing low points. So meaning this is our ideal, this is the high, this is now the low points. Since all of these pullbacks, we're not within any premium price zone. So we expected to see how price was supposed to return and dip into premium to take that out and then fall to the downside. This also created this low. This wasn't up to premium. We want to see how price will dip now to take this out before we have the continuation to the downside. So we have from the high to the low. So we want to see price takes out this deep into premium, and then we have the bearish continuation. So let's play price to see. So now we can see that price took out the inducements, the buy side liquidity, went further to take out this other buy side liquidity. So let's play price to see. Now we can see price fell to the downside, but then price have not taken out this swing low points. So let's take out the fib tool. So what we can see is that the market is also stacking an accumulation here. So let's play price to see. Now we can see price pushed to the upside into this fair value gap. Price failed to take out this low points. So we want to see price creates another inducement here then before we can have the bearish continuation to the downside. So we can see how price is just consolidating here. And what we can see is this is the midnight candle and this is the open price of the midnight candle. So I told us that we could see price takes out the open of the midnight candle in the London session, and then we have the bearish continuation. Price will open at midnight. We want to see price trade above the open price, and then we have the bearish continuation. So in this case, this is what we are having. So now what we can see is that this leg move, pull to the downside. Now we have this push to the upside, and now we can see price took out the midnight's open price. So let's play price to see if price is dipping more lower. Now what we can see is that now see what we have now. You see price created stack of the sell side liquidity to the downside here. Now you can see that price fell to the downside, but then price pushed to the upside. So you should know that price is aiming to take out this high points before we have the bearish continuation to the downside. So the market will always seek liquidity before falling to the downside. So this is now the ideal inducement swing high points. So if we want to consider the movement, just this movement that price have been making here, let's take the fib tool. Let's fib from this candle high to the low here. So what we can see is that price gave us the pullback. Price did not retest equilibrium or premium. Price fell here. Now we can see price return into premium. Based on this market movement, price fell, did not take out this low point, price returned more into premium, and then we have the fall that took out this sell side liquidity. But you know, our ideal sell side liquidity is the external, where we're expecting to see that the market will break. So market took out the sell side liquidity, but we're expecting a break of structure to continue bearish to the downside. So let's play price to see. So we can see price fell to the downside. We still do not have a valid break of structure yet because we want to see a candle body close below the low. And since this is not the new low, we want to see a candle body close below this low. So let's play price. So now you can see we have a valid break of structure to the downside. So price will seek liquidity at premium or equilibrium before returning to the downside. So price gave us this kind of a structure. Within this structure, from this high to this low, we had this structure being formed. So you can see our price dipped into premium, and then we have the fall of price to the downside. So what we can see is that we have this push of price to the upside. Let's take out this so that you can see clearly. So what we're going to see is when we map this, we have, this is the pullback. So you can see within that we have this price give us this fall to the downside. This is the last bearish candle. So the high that takes out this is the valid pullback. So you can see we have this price fell, price gave us this, price fell to the downside. Now we have this to the upside. So what we can see is that price gave us the pullback, price fell. We're expecting that impulse move. So now we can see price gave us this pullback. Now we have this fall to the downside. Price seeked the buy side liquidity. Now price gave the movement. Price did not take out this low points. Then we saw the movement of price. So we should know that price is seeking the buy side liquidity here before we have the bearish move to the downside. Hence why I told us to now make use of the fib tool from the high to the low here. So we can see price fell, price return, did not retest equilibrium or premium. You see the fall, price seeked it, seek the buy side liquidity, mitigated the premium based on this movement within this range from this low to this high. Now we can see price fell, failed to take out the low, price again return into premium, seek this buy side liquidity before falling to the downside. So this is just what I want to show us, guys. Till I see you guys in the next video. Cheers and God bless you all.